if you ever write a check to the federal or the state treasury for taxes, I would say that is one big mistake. You always want to keep that money in your bank, in your pocket. Do not, because real estate, that's why it's powerful. Not only do you have cost segregation, but you have so many ways to eliminate or reduce your income taxes. Take advantage of those. Be smart.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Joe Viery is the principal at U.S. Tax Advisors Group, Inc., and as a cost segregation professional, he has helped property owners defer or eliminate millions of dollars in income taxes by leveraging IRS-compliant cost segregation studies. Joe, welcome to the show.
Well, thank you, Sam.
Hey, the pleasure's mine. The same three questions I ask every guest who comes on the show. Can you quickly tell us, where did you start, where are you now, and how did you get there?
I've been an entrepreneur all my life. And so basically I owned another type of business, travel. And then after I sold my travel business, I segued into working with the California Association of Realtors as a financial planner. And somebody kept coming to me back, guess when, 2007, and saying, I've got this idea you should tell your people who own real estate about. It was called cost segregation. I blew them off for a year thinking it was a sales technique. And then after a year, we sat down and I go, well, you know, that's pretty powerful. I've got some clients who are paying income taxes. They need to do this. So I talked to my clients. I got involved with them, saved them lots of money. And then boom, the depression hit. And my role with the California Association of Realtors evaporated overnight. And the guy that owned the cost segregation company said, Joe, you're really good at this. Why don't you segue into cost segregation? And I have not stopped since 2007.
Wow. That's good timing, I would think, I would just think that would be good timing from a business standpoint, in that people are still going to need cost segregation studies done regardless of where the market is. So,
They do. I mean, the feds don't want you to not pay your income taxes. Right. Especially when the economy is down. They need as much money as they can. So they were going after lots of my clients saying, I don't care what the economy is doing. You need to pay us your income taxes.
Is there a difference, Joe, between passive losses and cost segregation depreciation benefits? Is that, I've understood that passive losses you can only take against passive income. Is Correct. The same true with cost seg, or is that part of it? Can you help kind of break some of that confusion down in my own mind?
No, that's a really great question. In fact, I will tell you universally, the circumstance of using and needing cost segregation, the acceleration of depreciation is very, very valuable. But the one question I always talk first, primarily with my clients, is, are you passive? Are you a passive or an active investor? So if you're passive, I give you passive losses. If you're active, I give you active losses. And to be honest with you, sometimes if you're passive, you don't need passive losses.
Right.
So I try and nip that, straight away and say, check with your accountant, because we're an engineering firm, not an accounting firm. And we say, hey, check with your accountant to make sure that if I give you passive losses, you can use them. Most of the time, passive investors still can use cost segregation, but not all.
Right. Yeah. That's the catch, is that, and I hear this advertised a lot in, pitch decks and things like that, where it's like, hey, 100% bonus depreciation this year, or whatever it is. And I'm like, yeah, that's only beneficial to the point that, it's a passive loss. And so you're telling me that, in certain situations, it's just not going to help.
Yeah, now some not. Like if you're talking about a multi-million-dollar building and I'm giving you hundreds and hundreds of thousands of dollars in passive losses, there's a cap on passive losses. It's $25,000 per year.
Okay.
So obviously I would tell them, don't do it. If you're passive, don't do it. However, there are some workarounds which are valuable. And then number two is that a lot of my clients now, we have a new methodology that we've had for like 5-6 years. And basically that's for single family home people. And those people, $25,000 is significant for, one home. If I give them $25,000, that'll wipe out their income taxes for that year and maybe a couple of years down the road. Because the way the losses work is they follow you until you use them up.
Right. Right. Yeah, and I've heard that, and that's something I never got into, which it's a little late now because I'm no longer buying single family residences, but I've owned lots of them for many years, and I never did a single cost segregation study on any of it. And
No,
it's like,
you wouldn't,
right,
because it costs so much money. Because to do a detailed engineering study, I have to send somebody out to that property, and we play by the rules. And the rules say you've got to document, measure everything, all the personal property and the real property. Well, no one's going to pay $4,000
no,
to send me out to, let's see, Memphis.
right. Right, right. How does somebody get around that? I mean, I've heard of certain companies that will allow you to kind of do your own self, cost segregation study. How does that even work?
Yeah, to me, that's a little bit dangerous to try and do it yourself, because this is an engineer. The IRS makes no bones about it. Cost segregation is an engineering-based study on the top level.
Right.
So bottom line is, sure, can you do another type? Yes, you could. But how we get around it is we've developed what's called modeling. And
Okay.
so we don't need to go to the property. We use our database of thousands and thousands of similar properties around the country, and we basically use an analytical statistical study, and we can give the owner of the property a single family home for buildings with a building basis of 500,000 or less. We can do the modeling study for hundreds of dollars. So
Wow.
now it's worth it.
Yeah, absolutely. Makes all the sense in the world. I mean, why would you not do it? Would be the
And,
question.
and there's very few companies that do what we do. So it wouldn't surprise me if someone listening on with their accountant would be going like, I have no idea what Joe's talking about. We have never lost, or been told by the IRS to reverse our findings. They have had questions. We've answered their questions, and they say you're good to go.
Right. That's great. That's great.
That is great.
Fantastic. Yeah. So we learn even something here on the single family side I didn't expect to learn about here today. One of the things that maybe somebody, if they're listening to this, hasn't thought about, and maybe let's say they're looking to sell their property in the near future, right? Or under contract to sell it. Is it still worth getting a cost segregation study done?
No, there's a component of the tax law which is called depreciation recapture. So my team, my talent, we've come to the agreement that if you are not going to hold a property for at least a year and a half to 2 years,
Right.
by the time you pay me, by the time you go through all the pain, by the time you get your accountant involved, I would tell the client, don't do it. If
Don't
it's a flip or a year and a half, 2 year less, don't bother.
Don't bother with it. Yeah, that's interesting. And that's a fascinating point you make, because even in multifamily, I mean, we're seeing a lot of things that have 5 to 7 year business plans and they're trading hands. I'm part of a deal right now, it's trading hands 18 months later. I mean,
Now, here's the deal. You're not going to get hurt by
right,
doing it. It's just if somebody came to me and they knew they were going to sell their property in 18 months,
right,
I would say, why? Don't do it. However, if you are thinking I'm going to have a 5 year plan, and then whoops, somebody came up with this offer I couldn't refuse to
Right.
sell them my property, then I'd say, don't worry about it. You're not going to get hurt. It just, you're not going to lose money. It's just, you're not going to have the powerful advantage of accelerating your depreciation.
right, right.
So,
Yeah, that's absolutely right. And that's, and again, if you're in the pleasurable position of having your 5 year plan be carried forward or carried forth in 18 months, then by all means, enjoy the fruits of your labor and move on. So that's really interesting. What about acquisitions? How far can you go back on an
that's a
acquisition?
really good question. A lot of accountants and a lot of clients don't understand that we can go back. Now, I'm going to take it to about the maximum. I have to do a calculation to see what the actual date is, but about 15 years.
Oh,
And
wow.
that's my experience. Now, I've gone back and made it work for 18 years. Now, what we're talking about going back to is when you acquire the property, because the depreciation countdown starts when somebody buys the property,
Right.
not how old the property is. If George Washington slept at that property, but somebody bought it today, the depreciation clock starts today.
Right.
So I can go back about 15 years, and we do this at no cost. We do an analysis, and then I'll tell the client, I'll say, hey, look, it's worth it. Or I'll say, if I were you, I wouldn't do it. It's not worth it.
Does somebody have to, I mean, you go back 15 years. I mean, does that 15 years of refiling taxes, or can you figure all that out in 1 year?
Uh, well, no. Here's what's going to happen. And this is important because a lot of people have the word amendment kind of baked in.
Right.
And what we do is, I will tell you right now, I do not use the word amendment, because in my industry, cost segregation, you do not amend your tax return. What the IRS has allowed you to do is simply file a change of accounting form. And this is the only use of that form, cost segregation, where it's guaranteed by the IRS. No questions asked. You file the form and you tell the IRS, okay, this is the depreciation I've taken. This is what Joe's given me in accelerated depreciation, and this is the net benefit. And I'm now applying this in my current tax return. So if you bought a property, not bought a property, but if you're filing your 2021 tax return and you bought a property 10 years ago, you would do the change of accounting method form and just tell the IRS what I just told you. Here's the benefit, and here's the depreciation I'm going to take because I'm taking advantage of acceleration.
Now, do you get to claim all 10 years of depreciation, or I mean, I know cost seg, the beauty of that is that it really compresses some of those timelines in that you get more depreciation earlier on, but how does that play out?
But basically what it does is there's an adjustment on that form, and the adjustment is relatively simple, not to calculate, but to think about. Basically, all you're doing is you're telling the IRS, okay, this is how much depreciation I've already taken. I use straight line. I've taken 10 years of straight line, and now I'm going to do the accelerated method. And here's the difference in the two. So you can't double dip.
Right.
But the acceleration, it's still, even 10 years down the road, is powerful enough that's called the look back study.
Right.
Most clients will do a look back study. It makes sense.
Right. Yeah. That's a fascinating point. I've never really talked about with anyone is doing a look back study on a cost seg situation. So tell me, I mean, is that something even worth doing on the single family side?
Yes.
Interesting.
Yeah, because obviously we're talking hundreds of dollars. So bottom line is, if you go back 10 years, now, if the property was bought 10 years ago for $20,000, then I would say don't waste your time. But if you're talking about 50 to $100,000, which is kind of, going back 10 years, property values were really low.
Right.
But I would still say I would do this at no charge. I would estimate it and say, look, yes or no. And if it's a no, I just tell them, don't bother.
Right. Right. That's really interesting. One of the things, that I read from you was if you owe taxes, if you owe federal income tax, was to call you guys and see how you can keep that money in your bank account rather than paying the IRS. What does that mean?
Well, I mean, would you rather write a check out to the IRS for 50 grand, or would you rather take the 50 grand and go out and buy more real estate or improve your real estate? So
Joe,
it's all about.
I feel like this is a guru. I feel like this is a guru lead-in pitch all of a sudden. Like, would you rather have a sharp stick in the eye, or would you rather have a fistful of money? Like, wait, what?
Well, that's why this is such a pleasurable podcast to talk to you about, because, I mean, what we do is that's what we're doing. We're giving people money, and it's like, you don't want it. Now, here's the deal. I mentioned one circumstance, passive, active, where I drill down. The other one is, are you paying income taxes?
Sure.
You don't need Joe if you're not paying income taxes. Don't call me.
Right.
But if your IRS, comes to you and says, hey, you got to write a check out for X. I don't care if it's 10 grand. I don't care. A lot of my clients are multi-million dollar. I do the single family, but I do the $500 million buildings also. And those tax savings are like on the $500 million. It was $100,000 it was $100 million in tax savings.
Right. That's a large number.
Large number.
Right. Yeah. And so explain that to me, where you say, hey, look, if you owe federal income tax, call you, because there may be a way to use property I'm assuming you're using cost segregation to give them a tax write-off. But if you already owe the tax, is there a way to go back and rework that? Or, I mean, what do you mean when you say that?
You can do that, but we're not an accounting firm, so I don't get involved too much in that aspect. But to answer your question, if I give you losses this year, you can go back. I believe it's 5 years and get a refund for the
Right.
taxes you've paid.
Right. Right.
But
Yeah.
we don't apply it. We just give you the answer. You have to apply the answer we give you and you get the money from the IRS. But it's part of the tax code. If you paid taxes 2 years ago and I give you losses this year, you could use those losses to get your money back.
Right. Yep. Yep. That's very interesting. Consult your accountant, for those of you who are listening to this, because Joe and I aren't accountants, but
Yeah, definitely.
That's fantastic. Hey, I'm enjoying this. This is fun. Let's shift gears a little bit, because you guys are an engineering firm, correct? Right. And so what else do you guys do outside of cost segregation? Because I think this would be valuable for listeners to understand what the full suite of things it is that you guys get involved in.
We also do the energy studies. And to make this simple, this is an engineering based study because there are tests that have to be performed by an engineer on site. And what we're doing there is there's three factors. One is the envelope of the building. The other one is the HVAC, and the other one is the electrical. The engineering of the building is basically your doors, your windows. Then you've got your electrical compliance appliances and your light fixtures, and then you have, of course, your HVAC. If anybody does a value add, a remodel job, I guarantee you nowadays, Home Depot does not sell anything that's not energy compliant.
Right.
It's baked in all over the United States. So if you've done any work, you're going to be energy compliant. You can tell the IRS, I've improved my energy by these standards, and therefore you'll get a $2,000 per door tax credit, not a deduction, a credit. So that's a valuable difference between cost segregation. I'm giving you deductions, write-offs, whereas in energy you get a $2,000 per door credit. And
Wow.
then the 179D is for big buildings, the 45L is for small, like multifamily and single family homes. And basically it's complicated, but again, we'll do a no cost estimate to let you know whether we think that you would qualify and then how much you're going to save.
Right. Yeah. And I would assume, I mean, is this something, and I know you said that Home Depot and Lowe's are going to carry, all the products that are energy rated, but I would assume that there's still, even outside of that, if you're going through some other suppliers, that there's a list of things you would say that this has to have certain stamps on it.
Yep.
That qualify.
The planning, the county planners nowadays, they just won't approve anything unless it's going to be done with energy compliant standards. So that kind of argument we really don't need to make much anymore,
Right.
because you'd be hard pressed to find a contractor that would go outside and try and find some used light fixtures that are, it just doesn't happen.
Right, right. Especially if you're working at scale. What about when you're doing like a facility that's only a half? Say the intention is only to renovate 50 to 70% of the units and then leave the rest for the next buyer to finish out. How does that situation play out?
Well, that works. You can just do those whatever units you qualify for. Yeah,
Gotcha.
definitely. Yeah.
Gotcha. And you guys will come in, you'll do the study for it. You'll say, okay, here's everything you guys did, and here's what you hand to your accountant for this project, and they will give you all the tax credits that you need.
Yeah, and on the energy studies, it's a little different because we have to give them a testing results, and that's what the IRS wants to see. They want to see that somebody went in there and they want to see that somebody tested the doors to make sure the doors are not letting energy or heat or air conditioning out. They want somebody to test the windows, and it's a machine that we have to take to. We don't have to do every single door, but we will go in one, like a one bedroom, one bath, unit, and we'll test that, and then we can use that information. But it's an actual test that the IRS would need to see if they were to ask questions.
That's interesting. So you would go to each, say there's a 1, 2, and 3 bedroom mix. You guys would go to each unit type. And then that's the end of the test. That's really fascinating. Very, very cool. Joe, I've learned a lot today. Thanks for getting into some of the nuance on cost seg. I knew I threw some things at you that were a little bit more maybe in the weeds, but certainly appreciate you breaking that down. And then of course breaking down the just how we can use energy efficient studies to get tax credits as well. So that's fantastic. I've really enjoyed this. Let's jump here into the final 4 questions. What is one tool or resource you find you can't live without?
I love using CoStar.
Hmm.
I think CoStar is really for me and my clients to find the information they give on properties and the data points is really, really valuable. And so I'm a big CoStar believer, and we use CoStar.
Gotcha. No, that's fantastic. I love that. Next question is, if you could help our listeners avoid one mistake in real estate, what would it be and how would you avoid it?
If you ever write a check to the federal or the state treasury for taxes, I would say that is one big mistake. You always want to keep that money in your bank, in your pocket. Do not, because real estate, that's why it's powerful. Not only do you have cost segregation, but you have so many ways to eliminate or reduce your income taxes. Take advantage of those. Be smart.
Yeah, absolutely. When it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
I am, as you probably figured out, I'm an energy efficient person. And so, I'm driving an energy efficient car. My house has solar, and we have a lot of energy efficient appliances and, doors and windows. And so that's my contribution. I try and give back.
Got it. I love it. Joe, if our listeners want to get in touch with you or learn more about you and what you guys do, what is the best way to do that?
Website. It's U.S. Tax Advisors Group Incorporated. To make it easy, just go www.ustagi.com.
Wonderful. Joe, thank you so much for your time today. I do appreciate it. Lots of fun.
Thank you, Sam. Appreciate it.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.